Welcome back to Quant Forge. On this channel, we test trading strategies with real data, real Python code, and real backtests. No magic indicators and no Lamborghini thumbnails, because the internet already has enough people selling courses on strategies they've never actually verified. Today, we're testing the most famous trading strategy ever put in a finance textbook, the moving average crossover, specifically the golden cross. You've probably heard of it. 50-day moving average crosses above the 200-day moving average. Buy signal, it crosses back below. Sell signal, that's it. That is the entire strategy. It has a name that sounds like something from Greek mythology. It is taught in universities, referenced in Wall Street research, discussed in books written by people with genuinely impressive credentials. So either the entire financial education system has been teaching something that actually works, or 8.5 years of S&P 500 data is about to make some textbook authors very uncomfortable. So let's go through exactly what we tested. The asset is the S&P 500. Daily candles, including a global pandemic, a historic bull run, a brutal bear market, and one of the fastest recoveries in market history, which is exactly the kind of varied conditions a strategy needs to survive to be taken seriously. The rules are simple. 50-day SMA crosses above the 200-day SMA, we buy. Golden cross crosses back below, we sell. Death cross. We start with $10,000, 0.1% transaction fee per trade, and run the full backtest engine with position sizing, fees, and mark-to-market equity tracking. Now, here's something that immediately stands out. Over 8.5 years, the strategy only generated 4 trades. 4, which on one hand means we're not overtrading. On the other hand, it means the strategy spent a significant portion of the decade sitting in cash, while the S&P 500 quietly went up. Let's talk about the results. Buy and hold turned $10,000 into $28,977. Total return of 189.8%, Sharpe ratio of 0.75. The Golden Cross strategy turned $10,000 into $19,138. Total return of 91.4%, Sharpe ratio of 0.55. So, to summarize, the most famous trading strategy in finance generated less than half the returns of doing absolutely nothing over nearly a decade. With worse risk-adjusted performance, 4 trades, 8.5 years, underperformed a zero-effort benchmark by 98 percentage points professionally. Now, there's one thing the strategy gets credit for. The maximum drawdown was identical to buy and hold, negative 33.9% for both, which means the death cross provided essentially zero additional downside protection. The strategy caught the same crashes, made less money in the recoveries, and somehow still managed to lose to doing nothing. That is genuinely impressive in its own way. But wait, what if the classic 50/200 combination is just the wrong parameters? What if the golden cross works? We just need to find the right version of it. So we tested every realistic combination. Short windows of 10, 20, 30, 50, and 75 days. Long windows of 100, 150, 200, and 250 days. And the best performing combination across all of them, 75/250. Final value of $20,838. Return of 108%, which sounds better. Till you remember, buy and hold returned 189%. So even the best optimized version of this strategy still underperforms the benchmark by 80 percentage points. That's not a parameter problem. That's a strategy problem, and here's why. The golden cross is structurally late by design. A moving average only reacts after price has already moved. So the buy signal fires after the recovery has already happened. The sell signal fires after the damage is already done. The strategy is always chasing a market that has already moved on, which means every single trade starts from a position of disadvantage. The entry is delayed, the exit is delayed, and the S&P 500 spends most of its time going up. So being in cash is expensive. This is exactly why backtesting matters. The golden cross is not a stupid idea. Trend confirmation, momentum alignment, systematic rules. These concepts actually make sense in theory, but in practice, on 8.5 years of real S&P 500 data, the textbook strategy returned 91%. Buy and hold returned 189%. The strategy didn't just underperform, it underperformed while taking the same drawdowns, which means it delivered less reward for the same risk, which is technically the opposite of what a trading strategy is supposed to do. So, does the golden cross work anywhere? Maybe on different assets, maybe on different time frames, maybe with additional filters. That's worth testing. But on the S&P 500, over nearly a decade of real data, the verdict is clear. The most famous strategy in finance is significantly worse than not trading at all, which honestly is a very human outcome. Anyway, this is what we do here on Quant Forge. We test trading ideas objectively and let the data decide what survives.